Josh. I'm a VC at a firm called Compound based in New York. We're a $50 million seed stage VC fund. Quick introduction. So we're very much a thesis-driven VC fund, and so what that means is we have a very strict set of thesis in several different sectors that we may spend the entirety of one fund, two funds, three funds only investing in those sectors. We publish those, and the idea is that we do very deep research and try and find companies that fit within those frameworks. So as I mentioned, we're a seed and early stage fund. Typically, we invest in the first couple $1 million into a company or project. Some of our crypto investments, the Graph, Compound, Keep, NewCipher, LivePeer, Blockstack, and we've made about 12 others as well. So we've been pretty active over the last couple of years. So I want to talk a little bit about how I think about investing in the Web3 space and the investment frameworks that go along with it. And most people probably know this, but to clarify, so the VC's dilemma, especially for a smaller fund like us that can't just collect fees, right? You could delete this whole slide for a fund over a certain size. But for us, it's to form investment theses, make investment decisions, build a portfolio, work closely with that portfolio, and help those teams realize liquidity through success. And that's how we get paid, is once all of our investors are paid out, and then we take a percentage of anything that comes beyond that. And so part of that is not just making kind of educated guesses on where the future is going. I can tell you about technologies that I think 10 years from now we'll all be using, but it doesn't really matter unless you can pick a company today that is able to take advantage of that and grow alongside those markets. And so I put this graphic up here as an example of the search engine market. So in the mid-90s, I could have been absolutely right that search engines would be one of the most valuable properties on the internet. But if I had invested in Lycos or Dogpile or something like that, it wouldn't have mattered. And so stepping back before going into how I think about investing in the space, because I think this is important to frame the discussion. So what are blockchains good for? I imagine most people here have a good sense for that. But also, why should anyone care? What's the value in blockchains? And so here's how I think about it. When we access the internet today, using our smartphones, our laptops, we're accessing remote servers, and those servers are managed by essentially root administrator or super user, whatever you want to call it. In the case of, let's say, Facebook, if I take a photo on my iPhone and then I upload that photo to my Facebook profile, essentially then that's owned by them. They can delete it, they can edit it, they can access it, they can leak it, but that creates sort of a honeypot for hackers. And so anybody then that has access as the super user essentially can do that as well. And so they know exactly where that data is. It kind of lives in one place. And so blockchains enable computers to reach consensus on a state of the world by removing the need for that root server or administrator, trusted third party, whatever you want to call it. But there are limitations, and most of these have been mentioned today in one way or another. But they're slow, they're expensive. You can access data from the outside world, as people refer to as kind of the Oracle problem. There's a lack of privacy, because in order for the system to be trustless, anybody has to be able to access the entire full history of the blockchain as well. And so in terms of where I think that use cases today make sense, I think there's two axioms, and it sort of is where they meet in the middle. And so the first axiom, where these super users or root administrators actually cause the end user harm in one way or another. And B is where you can withstand current limitations, the things that I mentioned before and a couple of others, because the experience that you're interacting with in an application is something that wasn't previously possible or is still such a vastly better user experience than what exists today. And so you're willing to put up with the user experience of a decentralized application. So put differently, where's their value in executing just the part of the computation that needs to be both secure and reliable? And Nick Szabo calls this fiduciary code. And so moving into the investment theses, the way that I think about it is, how do we plan from today until 10 years from now, where we can look at a company and look for a way, like different timelines and objectives. So in the short term, you can actually get users and get feedback and continue to iterate upon your product. But maybe that sort of mass market or that opportunity may not come for years from now. And so going back to that axiom slide I had before the Venn diagram, The first thesis, and there are more of these that we have internally, just for time's sake, I'm only going to share 2 here, but for number 1, given the cost to settle a transaction and the speed and scalability of blockchains today, my belief is that the decentralized financial infrastructure are the primary use cases that make the most sense, where they can be asynchronous. They tend to be higher value transactions, and so you might be willing to pay high gas fees, for example. And I think that's where the killer applications could come from in the next couple of years. And so the investment framework would be to invest in protocols and applications that cater to these use cases. A couple of examples here. The only one of the 3, just to clarify, that Compound VC is an investor in is Compound, coincidentally. Veil, which is a decentralized application built on Augur. Compound, and Robert presented earlier, so you guys know what they do. And DYDX, which is both a protocol and application for decentralized derivatives. And so the second thesis, in order to reach critical mass in adoption for these decentralized applications, there are several weaknesses we talked about before and others with public blockchains today. And my belief is that a lot of these things need to be solved by protocols that aren't part of the base layer, adding complexity and potentially opening up security holes at the base layer as well. And so the framework would be to invest in protocols. Most of the time, these end up converting to tokens that basically help to power these protocols that solve known weaknesses and problems with public blockchains. Oftentimes, these are work tokens, and I'll get into in a second sort of what I look for in a token model. But they also need to be used often enough in the protocol and designed in such a way that they actually accrue value. So for each user that's actually using the token, the next person is not just selling it to a new user, and so it kind of stays stable from that perspective. So some examples. And again, to clarify here, we're actually an investor in the first 3. So Nussbaum, which is a protocol for proxy re-encryption. It's the ability to basically re-encrypt a piece of data based on certain conditions under somebody else's private key that you own and you store yourself. The Graph, you guys know what that is. Off-chain Labs, and their primary product is a protocol called Arbitrum, which is an off-chain verifiable computation protocol. And Witnet, which is a decentralized Oracle protocol. And so as I mentioned before, in order to evaluate these things at this stage, you have to have a sense for what success looks like and what it looks like over certain time periods. And so really, to me, what success looks like is something like this in the blockchain space. But in all seriousness, this is a framework, and it's sort of a rough way that I think about potentially how you can judge success, especially for a protocol where it's not so clear. And in the first year, I would like to see the team making significant progress towards solving some of the open technical questions that initially existed in their research, and having sort of a roadmap going forward of what they can do once they solve those problems, and to basically get to a place where they're still solving problems, but the key problems in order for them to actually launch what they're building are solved at that point. Year 2, similar to a SaaS company or a marketplace, would like to see increasing supply, and you can use month over month or year over year metrics, but so you have sort of compounding interest in terms of liquidity. It could be compute, it could be storage. For the DeFi protocols, it could be liquidity, for example. And I don't know yet what exactly that growth rate should be, the way that I do for SaaS companies or marketplaces, because we don't have that data yet. But you do want to see it increasing, or at least staying stable today. By year 3, we're looking to see proof points that, one, the protocol works, but also that there's demand. And so starting to see kind of initial data points of developers who are building applications for end users using those protocols. And I wouldn't expect those applications to have users yet, but there's at least demand, and there's buzz building. It's not just sort of released out there and kind of waiting to see what happens. And in some cases, it might be in teams' best interest to actually go and build that themselves, those applications, to see what that demand looks like. And by year 4, I'd like to see the ecosystem growing. It doesn't need to be huge and massive and thriving, but where there's protocol development that happens outside of the kind of initial team. People are working on applications, and there's a growing user base for those applications, and a growing user base in terms of developers. And by year 5, I'd like to see them get to a place where the core team can start to step away. Maybe they're still working on it, but it's not full-time, or the team kind of shrinks in size as the protocol moves towards becoming decentralized. And so when it comes to tokens, here's a couple of factors that I think about when we invest in SAFTs or LLCs that dissolve and we get tokens versus equity. And so number one, will the value increase directly in proportion to the growth of the protocol itself? So what wouldn't be good is if a lot of people were using the protocol and you had a token that was kind of glued onto it and nobody really needed it. And so as a result, the value of the token wasn't increasing in proportion to the protocol itself. It'd be very hard to fix that problem. Number two, is the token necessary at all? Do you get benefits to having security tied directly to your protocol versus using something like Ether, DAI, et cetera? And number three, which is a little bit ambiguous, but if the token is deemed a security, or we stay in this kind of unknown regulatory environment, can the team get by working with, let's say, accredited investors and enabling them to do the work with those tokens until they work out the regulatory piece and kind of create or build it in more of a trustless way? So you can at least get off the ground and get running and see what the issues are and get some of that demand as per the previous slide. And lastly, are there velocity sinks or other mechanisms that influence liquidity? As I mentioned before, that idea that if usage is growing but people keep selling these tokens and velocity is very high, it won't accrue value. And at the same time, you don't want a protocol where the service becomes prohibitively expensive because people are just speculating the token through the moon. And this is a topic that comes up a lot, and I don't think we have all the answers here, but it's defensibility, both with protocols, given that they're open source and trustless in nature, but also with applications in the space that are built on these protocols, different than applications today where you're storing all of that user data. And so these are the 4 tenets of defensibility in general, not just related to the space, but network effects, economies of scale, brand, and switching costs. And so going into detail on each one, with the protocols themselves, the way that I think about network effects, and this is something I've gone back and forth on for several years now, especially with smart contract protocols, where you sort of initially look at maybe it's pooled security, maybe it's development that's happening, but then the argument is, well, chain interoperability would make it so that all these chains are interoperable with one another, and so that defensibility doesn't really exist. And I've changed my thinking on this just last year, where composability is extremely important. And so, as Robert from Compound mentioned earlier, the ability basically to use multiple protocols or call multiple contracts with a single transaction. And I included a quote here from a friend of mine, Jesse Walden, who wrote a blog post on this subject, who said that a platform is composable if its existing resources can be used as building blocks and programmed into higher order applications. And so, if you're using an application that's attempts to use multiple protocols and they're on different shards or different chains, it's asynchronous, or one transaction executes and another one doesn't, that can become an issue with some of the use cases that I think are compelling. And so with applications, I think about this from a lot of our marketplace investments where you can basically chart all of them. They reach a place of critical mass on the supply side, which brings more on the demand side, and so on and so forth. And I think in this scenario, it's the liquidity. So if you want to use, let's say, Veil, as I mentioned before, or any real Augur DApp, if you were to actually get a lot of liquidity on those markets, you can create an interesting barrier to entry. And then what are the switching costs with forking? And so this applies to protocols, but it applies to applications as well. And so for applications, they can point to the fork or the original protocol. They have that decision. But once you have developers who are building applications and protocols that are all hooking into one another, you get to a place where it's very, very hard, and it becomes much harder to fork at that point. And a good example from history would just be the browser wars, where you have to be bug for bug compatible, not just API compatible, and saw all sorts of issues with Microsoft's Internet Explorer over time. Oh, sorry. Here we go. And so brand for decentralized apps in particular. Google example and Gmail is my favorite, where basically Google has critical mass with Gmail, but it's in their best interest to use the open email protocols because otherwise they're just limiting the number of people that their users can email, and it would basically seed growth. People would go to a different email application. And so as a result, what ends up happening is brand comes through competing on cost, privacy, service, UI, UX, performance, security, et cetera. And at the end of the day, I think the consumer wins. Why does it keep? With protocols, the brand that really exists is more trust in the team and who's maintaining it, and familiarity. I sort of view forks as a cap on rent seeking. So if the protocol is designed in such a way that there is extreme rent seeking, then people might go to great lengths to actually fork the protocol. But I think it's higher than people think, especially over time. As mentioned before, once you have applications and protocols that are all hooking into one another. Economies of scale. One could argue that this might be network effects. Economists go back and forth on what are economies of scale and what are network effects on internet platforms. But this is an interesting thing that I've been thinking about recently, where if you were to build, let's say, an app on the Augur protocol, and you have some users and you have revenue from those users, instead of just doing what teams do today and reinvesting in the product or hiring and scaling quickly, you can also go and, let's say, buy rep and participate in market disputes and earn more of that rep. And in theory, in more of a perfect market, you would have the price of rep increasing as well as usage of the protocol increases. You can provide liquidity to those markets to help build that barrier to entry talked about. And so interesting positive feedback loop that you can do with a decentralized application in certain protocols that doesn't exist in the centralized web. And you can kind of rinse and repeat. So you can also use those proceeds to go further in terms of acquiring users and improving the product. And we've seen traditionally that value on internet platforms tends to accrue to that who is closest to the user. And so in summary, my belief is that success in the short term will be we'll go to those basically who are building for use cases where you can withstand issues with public blockchains today, with longer term roadmaps in mind in order to be able to take advantage once the technology reaches more of a steady state. In addition to these apps and protocols, infrastructure that solves for these issues specifically needs to emerge and is starting to emerge, but I think that's critically important. So we get to a place where you can, like Lego blocks, use several different protocols to solve certain problems rather than relying on a single protocol, where one issue or congestion on the network or whatever it is could really hinder development. And those two really go hand in hand over time. So you need people to sort of build applications, get users engaged in order to attract more people to build that infrastructure and to see what those problems are and what the best ways to solve them are. But I think it will reach a place, and I don't know from a timeline perspective what this might look like. I would say maybe a decade or so, but where the protocols themselves reach pretty mature state and all the development then happens at the application layer, which would enable new applications that I'm certainly not smart enough to tell you about here today. But a couple of examples would be, Uber would have been very, very difficult to build before we had 4G LTE everywhere. Instagram, until the camera on the iPhone reached a certain point, there was no point in everybody becoming their own photographer and throwing filters on what they were doing because the quality was still very low. And that's it. If anybody has any questions, comments, there's my Twitter handle and email. I'm always happy to answer. I don't think we have time for any more unless maybe we can get one in if anybody has any questions. No? Cool. Sounds good. Well, thank you, everyone.